Okay, let's have a look at our rates. Big week on rates, and it fixed a problem that we had over the last few weeks. The inverted yield curve. Well, it's gone, so we don't have a predictor of a recession anymore. Last week I did this. I said I'm going to make the bull case for equities, and this week I'm going to make the bear case for equities. And I'll be honest with you, I had a very challenging time making a bear case that I couldn't quite easily refute. There is a bear case out there, but every time I try to make it, I think, yes, but hang on a second, there are these countervailing factors over here. And I end up right back where I started, which is, okay, that pathway's not going to work. So I think the only bear case I can make is a policy mistake. And I'll explain more of that later on. Later in this video, I bring in Dave Harper from Bionic Turtle to talk about the housing market because he's invested in home builders, so he's up a lot more on the home sector than I am, so we'll have a conversation about that. But let's start with our rates. Look at that last week, all green, all yields, all par rates increased. And here's our change since the beginning of the year. If we look at the 2-year, 253, didn't move very much, 244 to 253. The 10-year moved a lot, 34 basis points. Look how much the back end of the curve moved. For the longest time, it was the front end of the curve that was moving a lot, and the back end would sort of drift away and not really move as much. But now the back end of the curve, from 5s all the way out, had big moves, whereas the front end of the curve barely moved at all. I'll talk about the 2-year down here in a second. So what this has done, here is slope now. Notice that the 2s to 10s have a positive slope, not inverted. The 5s to 10s not inverted. The 2 to 20 not inverted. The 10 to 30 is inverted, but I think we have still a price insensitive buyer at the 10, which will probably go away after the May meeting. We'll look at the Fed's balance sheet there, and that will probably I think might disappear. The 3-month to the 5-year, the 3-month to the 10-year, steeper, as you can see over here as well. So I mean, this, when I see 2 basis point moves, positive, negative, it's like, well, that's just noise for the week. It could have easily as finished at 0 or +1, depending on the last few transactions that happen. The big story is you have a steepening of the curve pretty much all the way across, and you have higher yields over the course of the week. We can see the change here over the course of the week. All of them were positive. If you are a subscriber to the CFA content level 1 or level 2, or if you have the applied options course, I did put a seminar in there. The seminar is in level 1 regression and level 2 multiple regression. This seminar is in the applied options folder for the market update. And it's I'm using regression with Excel. I show you how to use Excel, how to use regression in Excel, and how to download data from the Federal Reserve Economic Database. And the question we asked, this was more of an applied video, but because I used regression, I thought, aha, this is going to work great in there. Let's stick it in there. We asked, is the 2-year Treasury over, under, or fairly valued based on its ability to predict the Fed funds rate? And it has a very good predictive ability for the federal funds rate about 6 months out, somewhere between 2 and 4 Fed meetings. And the conclusion I sort of got to was whatever damage is being done to the 2-year is being done. I think it's all in. So to see it only move 9 basis points, to me that makes sense. I think the 2-year has pretty much got it all priced in at this point. So I'm not thinking that the 2-year has a lot of movement to go. So to see this happen at the back end of the curve while the 2-year stays relatively anchored is in line with the conclusion we got from this. So if you do have access to that, go ahead and have a look at that. there's our moves in rates. Let's look at break-evens and real yields. Real yields all up, much like the nominal yields were the par yields. We now have a positive 20-year real yield and a positive 30-year real yield. The 10-year looks like it's going to get there and probably going to turn positive. If the trend continues on, probably turn positive before the end of the month in anticipation of the Fed moving aggressively at the next meeting. We also have CPI coming in this week, which really could push these yields one way or the other, depending if it comes in hotter than expected or if base effects start rolling off and it comes in lighter than expected. We're going to look at the Fed minutes in a second here. Yeah, so we got real yields here. Inflation expectations captured in the break-even rates, the 5 to the 30, all up. Not a lot. I mean, these are not big basis point moves, but they are all up. So that the break-even rates have increased across all the tenors, the 5, 7, 10, 20, 30, kind of making the case for 50 basis points here because as we read in the minutes, one of the statements was that the committee notices that the market has really done a lot in terms of tightening already by raising rates in along the yield curve. They're already there. May as well walk through the 50 basis points because it's already there. It wouldn't really move much. So it is making the case for 50 basis points. So on my probabilities, I'm still 0 on 0 basis points. I think next week I'm just going to drop this off because why keep saying I don't think we're going to 0. I don't think there's going to be a case where I can make a non-zero probability about 0. I was 55 and 45. Now I'm 50-50 again. We do have some visibility on balance sheet reduction from the Fed minutes for U.S. Treasuries, $60 billion cap. The talk is after the May meeting, they will let coupon bonds run off. And if that doesn't hit the $60 billion cap, they will then let T-bills run off to hit that $60 billion cap. And for MBS, principal runoff up to a cap of $35 billion a month. So a potential of $95 billion a month starting right after the May meeting. And we'll read that in the Fed minutes. Let's read our statement because this is really the big story, our interest rates. What is going to happen to interest rates? And it's going to be affected by Fed policy for the overnight rate, the Fed funds rate, and for the size of the balance sheet. Specifically, what securities are they going to let run off? This will tell us where on the yield curve we would expect to see that effect show up in the months in which it wants to do it. So you know how to get the Fed minutes, the FOMC minutes. I've given you links to that in previous market updates, so you should be able to access that. You should have that bookmarked. I encourage you to read the whole thing. A lot of good information in there about their economic outlook, their financial outlook. A lot of good information in terms of, well, what are they seeing and what are they thinking about what they see? But here, we're just concerned about the balance sheet and interest rates. So let's read what we have here, and I highlighted certain points. All participants agreed, and these are minutes from the March meeting. This is what we're reading here. So in the March meeting, all participants agreed that elevated inflation and tight labor market conditions warranted commencement of balance sheet runoff at a coming meeting with a faster pace of decline in securities holdings than over the 2017-2019 period. And you'll recall there was 1 year in there where the S&P actually had a negative year. Didn't like that. And this is saying we can do it at a faster pace. Participants generally agreed that monthly caps of about $60 billion for Treasury securities and about $35 billion for agency MBS would likely be appropriate. Participants also generally agreed that the caps could be phased in over a period of 3 months or modestly longer if market conditions warrant. Most participants judged that it would be appropriate to redeem coupon securities up to the cap amount each month and to redeem Treasury bills in months when Treasury coupon principal payments were below the cap. So the Treasury bills roll off really fast. Coupon bonds, if you bought a 5-year coupon bond, well, you're holding it for 5 years. So every month there are some coupon bonds that will mature. They'll let those run off. If there is still room to make it up to the cap, they will allow bills to run off up to that point. But if the coupons hit the cap, they'll just reinvest all the bills. Where do we leave off here? Under this approach, redemption of Treasury bills would typically bring the total amount of Treasury redemptions up to the monthly cap. Let's see what else we have. Participants generally noted that MBS principal prepayments would likely run under the proposed monthly cap in a range of plausible interest rate scenarios. Well, you've been through level 1, we've been through fixed income, mortgage-backed securities. Why is this the case? Why would principal prepayments, not principal repayments, but prepayments be low? You generally don't refinance your mortgage while rates are rising. But if you had a mortgage with a high rate and mortgage rates are dropping, you generally refinance your mortgage at lower rates. So as rates go up, prepayments slow down. Some participants noted that under the proposed approach to running off Treasury and agency securities primarily through adjustments to reinvestments, agency MBS holdings would still make up a sizable share of the Federal Reserve's asset holdings for many years. And then the important stuff I put in green here. Participants generally agreed that after you gotta pay attention to these words, that after balance sheet runoff was well underway. So this is some time out. After it was well underway, it will be appropriate to consider sale of agency MBS to enable suitable progress towards a longer run SOMA portfolio composed primarily of Treasury securities. So in case we're worried that, well, they're going to start selling MBS, they're very clear here. After balance sheet runoff was well underway. So the sell-off we've seen in mortgage REITs in the last little while was an anticipation that they're going to start selling MBS. Well, this is some ways away. So I think that we might see some recovery or some bounce in the MREITs. A committee decision to implement a program of agency MBS sales would be announced well in advance. So they're saying, this could be some time away, up to a year away. They're going to let balance sheet runoff get well underway, and then they're going to announce sales of MBS well in advance. So I would not expect sales of MBS. My best guess is probably for about a year, maybe first quarter of 2023, early second quarter of 2023. Okay, so this is all we need for the balance sheet. There's a lot more interesting stuff here. Again, I do hope you would read it. What do we have here? No decision regarding the committee's plan to reduce the Federal Reserve's balance sheet was made at this meeting, but participants agreed that they had made substantial progress on the plan and that the committee was well placed to begin the process of reducing the size of the balance sheet as early as after the conclusion of its upcoming May meeting, which is a month away. So after they conclude the May meeting, they may then, right after that, begin the process of allowing the balance sheet to run off. That does not mean after the May meeting, meaning the next meeting. That means they're not going to do it before the May meeting. They're not going to announce an intermeeting balance sheet runoff. I've heard some commentators on Bloomberg say, the Fed might do an intermeeting rate hike or might announce the balance sheet runoff intermeeting in the middle of two meetings. But they're saying here that they would do it as early as after the conclusion, not before, but as early as after the conclusion. So I think we're clean all the way to the May meeting. This is interesting, the staff review of the economic situation. That's really interesting. It goes through a whole bunch of different points. Staff review of financial situations. This gets really interesting as well. It talks about volatility. It talks about spreads in investment grade, speculative grade corporate bonds. It talks about liquidity conditions, credit quality. Whole bunch of interesting stuff if you're into that. Let's keep going down to page 10. And we want to look at the interest rate outlook. Many participants noted that with inflation well above the committee's objective, inflationary risks to the upside, and the federal funds rate well below participants' estimates of its longer run level, they would have preferred a 50 basis point increase in the target rate for the federal funds rate at this meeting. A number of these participants indicated, however, that in light of greater near-term uncertainty associated with Russia's invasion of Ukraine, they judged a 25 basis point increase would be appropriate at this meeting. And you'll recall in my weekly update before the March meeting, I had cited that specifically, saying that with this uncertainty that just showed up, I doubt they'll go for 50 basis points. And in fact, I put a 100% weighting on 25 basis points associated with that, specifically because of that, and they noted here in the minutes. In blue, many participants noted that one or more 50 basis point increases in the target range could be appropriate at future meetings, particularly if inflation pressures remain elevated or intensified. And throughout this, they mention inflation a few times, and they do believe that inflation will return to the central bank's target rate of 2%. They don't just notice demand, they note supply as well. So I don't know how many 50 basis point increases there would be. The last part here I didn't highlight. A number of participants noted that the committee's previous communications had already contributed to a tightening of financial conditions, as evidenced in the notable increases in longer-term interest rates over recent months. So what this is saying is that, look, rates have already moved as if we were going to do 50. So why not do 50? Even if we did 50, it would probably do no damage because rates have already moved to anticipate that we would do that. And then the rest, there's some interesting stuff in the rest, but it's not long. It takes maybe half an hour to read the whole thing, but I do encourage you to read it. Let's look at this relationship between the Fed funds rate and the 2-year Treasury, and I'm going to show you how to get everything all the way from the very beginning. Okay, let's move on to earnings. We are in that season now. We've already had 14 companies report. You got 20 coming up in our shortened week. Good Friday is making the week only 4 days. So remember, options expire on Thursday this month, not on Friday. This top chart I have here shows earnings revisions from the 1st of January to April 8th, and we can see that they are downwards, 2% down. Q1 2022 year over year, we're expecting a 6.1% increase in earnings over last year's Q1. If you remove energy, only 0.6. So we can see here's our 6.1% here. Here's the growth that's expected. Here are the sectors. The ones with red are going to be negative. Consumer discretionary, negative 3.9% lower. Sorry, not 3.9%, 3.9 billion less in earnings, which is a drop of 12.4%. Financials expected to have a drop of 23% in earnings, and you have communication services down 5.2%. But look at earnings, 239.2. So if you remove earnings, if you remove energy, the earnings growth year over year for Q1 22 over Q1 21 is only 0.6%. That may question the multiple that the market trades at, and maybe with that kind of growth it might be a lower multiple. Maybe. 72 companies have had negative EPS pre-announcements. And the market's forward PE, now that we're in earnings season and earnings season has started, the forward earnings flips to the next quarter. So it's Q2 22 to Q1 23. The forward earning is now at 19.2. We'll look at what the EPS, the consensus EPS will be on the next screen. We have 14 companies. I think I said this backwards. I said 14 have reported, 20 will. It's the other way around. 14 companies are reporting this coming week over the next 4 days. We'll have a look at which companies those are. Some big ones, some big names, especially in the financials, so we're going to want to pay attention to that. 20 companies have reported so far. And of the reporting, the EPS is coming in 2.4% above expectations. Earnings are coming in higher. That may sound good, but that's versus a 4.1% average over a long period of time versus a 13.3% average over the prior 4 quarters. So even though you're getting earnings beats, which you normally do because companies tend to guide a little bit lower and tend to beat it, they're beating it by less and less and less. And it appears that they're beating, lower expectations on earnings. In the consumer discretionary, we're going to take a closer look at auto and housing. Housing, we're going to look at today. Autos, I have an upcoming video specifically for the auto sector, specifically GM and Ford, and even more specifically contrasting legacy automakers. And I don't like calling them that, but automakers that have their foot in the legacy in legacy industry or a legacy business versus those that don't. And we'll look at housing. We'll take a deep look at housing today because it is an employment driver. And if we have higher rates, higher mortgage rates, we would expect it to show up, the symptoms of that to show up in the housing market first. Because I don't necessarily have to go out and buy a house. If it's too expensive and I can't afford it, I'll continue to rent. So we should see something rolling over there first. And just as a spoiler, it's not very clear. Okay, this is earnings growth rates for Q2 2022 because we're in earnings now for Q1. So when we look forward to the next quarter, we're now looking forward to Q2 and what we can expect there. We see the consumer discretionary is not going to be negative anymore, but is showing something positive. These are forecasts. Keep that in mind. These are the consensus forecasts, which means you look at everybody's forecasts, you compile them, you take the median and you say, well, wisdom of the crowds, we're going to take this, right? There's always revisions to these, upwards, downwards, but here's where we are so far. Energy moderating a bit, still 136% over the second quarter of last year. Financials still in pain, another 17.5% lower than the second quarter of last year. Communication services showing negative, and utilities are going to be showing negative quarter over quarter simply because their input costs have really increased. Showing 6.9% growth in the second quarter of 22. So these are the growth rates with energy in it. It's Q1 6.1%. Again, you take out energy, it's not very attractive at all. Q2 6.9, and you can take out energy, just eliminate this the row for energy, just re-add these two, and then you can figure out what the growth rate would be without energy. Q3 10.8, Q4 10.8, Q1 of 2023 13.7. So it looks like if we can just get to October, we'll start to see that, hey, you know what? Things are okay. Companies have adjusted. Everything is just fine. That's where the consensus is right now. A lot of smart people thinking that. Let's look at forward PEs. CY is calendar year. Calendar year 2022, which is Q1 2022 to Q4 227.7 gives us a forward PE of 19.7. If we're looking at the next 4 quarters, which is a forward PE, this is the last 3 quarters of 22 and the first quarter. In other words, it's this. If we're looking at the next 4 quarters, 234.18. So that's a forward multiple of 19.15. If you jump all the way to calendar year 2023, this is Q1 2023, which is this number, plus the next 3 quarters. There is the consensus EPS, there is the forward multiple, and they even have a calendar year 2024 at 276 at a forward multiple of 16.22. So here is an interesting question. Why even do this? Why would we even use that? We're still over here. Why would we just jump ahead and start pricing out 2023? If you are expecting the year to be an outlier, you may want to look past it. So if you think, well, here's the trajectory of the market long term. And of course, it never does that. This is what markets do. They do this kind of stuff over time, right? But, you have this trajectory long term, and it'll oscillate in and around there. Well, if you're expecting this period of time to be highly volatile and not very representative of what we have going forward, if you expect something like this, you might say, well, I don't know that we want to put too much stock into this. Let's look past that. Now, we're not saying that we're going to see something like this, but what we're saying is, being that we have so little visibility and so many risk premiums associated with central bank missteps, the true nature of inflation, Russia, Ukraine, is Russia gonna go nuclear? I mean, we don't know. Since we have so much of this to look at, that the market is probably saying, well, you know what, this year's messy. It's ugly. But we think it'll all be cleared up by the year end. We'll have a lot more visibility by the year end. What are we priced at for 2023? That if I bought the index right now, and I'm willing to be a long-term holder, maybe I'll look past this year and I'll say, well, really, I'm looking at 18 times 2023 earnings. I'm comfortable buying that now. Or maybe you're looking at the options for 2023, the January or whatever options you have for 2023, saying that, well, you know what, I don't mind selling puts at this price if I believe these numbers even into 2024. So if you expect that the next 2 to 3 quarters have a whole bunch of uncertainty that you can't see beyond, but you think you know where you're going to get to, in other words, at the end of the year, I think we're going to be here. I think the central bank will be here. I think rates will be here, and we're over here. I just don't know how we get there. Do we get there this way or do we get there like this? I don't know how we get there. Either way, I'm not going to look at it, and I'm just going to look at the multiple of the next year. So that's sort of why it's priced out there. This is not unrealistic. That is well within the long-term average of forward PEs. Even this is not unrealistically priced if we believe 2023. So maybe 19.7 isn't so bad right now. We're going to see as earnings come in if earnings can support the estimates that we have for Q1 2022, and if any forward guidance is given that gives us some idea of what we can expect for the rest of the year. Okay, let's have a look at who's reporting in the week coming up. On Monday, April 11th, you have nobody. I thought I'd show you that anyways, just in case you say, how come you never showed Monday? There's nothing happening Monday. On Tuesday, you have CarMax. I think that'll be interesting, only because of the lack of supply. So I think that's going to be extremely interesting. The estimate is for 125. A year ago, it was 127. So we know that used car prices are significantly higher year over year. So there's a lot bigger margins there. At least you think there might be bigger margins there. However, volumes will probably be lower. I'm interested to know how low volumes will be. It is expected to be down 1.6%. It's on Tuesday in the morning, so if you're interested in the auto space at all, any of the automakers, this might be interesting to watch. And its commentary and its conference call might have something to say about the state of the industry. Let's have a look at Wednesday. Fastenal, BlackRock, Delta, First Republic Bank, and JP Morgan. So JP Morgan, I think, will be a big one to watch. Look at that drop, 41% drop in EPS. And Delta Air, a year ago, was negative 355. Expectation negative 132. That's going to be kind of important to watch. I think BlackRock expected to be up 16.8%. Fastenal up 20%. If some of these companies can beat these expectations going into Wednesday, it's going to start to look good for the week for the markets, especially JP Morgan. If JP Morgan comes in greater than that 269, even comes in significant, like 3 or 310 or even higher, that's really going to give a lift to markets. But if it can't beat this, then that negativity, I think, will weigh on markets. So Wednesday, when is it? 8:30 a.m. in the morning. So you're going to get it an hour before the market opens. Good. We'll see what's going on. It's all of these are AM, so that's kind of nice. Let's see what happens on Thursday. Morgan Stanley, 7:30. Citigroup, Goldman Sachs, I told you they were big ones, right? You got Wells Fargo, US Bancorp, State Street, PNC Financial, and then you've got United Health in there. So a lot of financials this week. It's expected to be down the most. If they can, I do expect that they will be down year over year, but if they can be down by less than these expectations, that really gives a lift going into the end of the week. We could go into a long weekend with a nice rally on the market, but if they come in light, if they come in under these numbers, and especially if guidance is weak or guidance is to the lower end of what the range was before, yeah, Good Friday could be, thank God it's over Friday. So there we are for what's on the earnings calendar for this week. Okay, so I think the week coming up, earnings, not just the week coming up, but the big event coming up now that could move us in the markets are earnings. And not just the EPS, but what's going on with margins. Because we are at higher levels on margins than we've historically been. So I've got this chart up here. This is corporate profits after tax. This is without any inventory valuation adjustment or any capital cost allowance. And for the longest time, 6% was really considered a mean reverting level for corporate profits after tax as a percent of GDP. That 6% was really seen as that mean reverting level. But after 2000, once China got into the World Trade Organization, we seem to have gone to a different level. That we seem to have a mean reverting level around 10%. We're up around 12% right now. By the way, the forecast for net income margins, because that's what these are, net income margins, the forecast for this is over 12%. And we're up at the upper range of 12% right now. Are we at a new mean reverting level? You can't really say that all of this was liquidity fueled. We're going all the way back to 2000, unless you're going to count Greenspan getting the rates down to 1%. That was distinctly different than any federal bank regime before it. So we could argue that, but the real big jump in liquidity came in here. But during this period of time, margins were dropping, and then you had, of course, the pandemic that happened. So I don't know. Is this the new mean reverting level, or are we going to see it come back to 6%? So I've got two lists of arguments up. I made the argument for it coming back down. We are facing higher costs. During this period of time, from 2000 onwards, you pretty much had this really big moderation in inflation, that it was deflation that seemed to be the biggest enemy. Central banks were talking about, what do you do when you hit the zero bound? How do you fight deflation when you're at the zero bound? Well, quantitative easing, yield curve control, all of these things. So the conversation really wasn't about costs. Well, now we have higher costs, so maybe that's going to affect margins, and we'll see it revert back down more towards 6%. We have higher costs combined with less than perfect pass-through. Companies aren't passing through 100% of their costs, or are they? We won't know until we see earnings come out and we see what the margins look like. We do have, in the last little while, a move towards relocalization, introducing supply chain redundancies, and this is all in the word of supply chain resilience. If you want a resilient supply chain, you have to build in redundancies, diversification in your supply chain, relocalize some of it so that we don't fall into the same problem that we have now, where there are supply bottlenecks everywhere. Maybe a company wants a captive source of supply of a key material. We're seeing auto companies partnering with semiconductor manufacturers in building facilities in North America. And if they're partnering with them, they have a captive supply channel there, but it's a redundancy, which means you're going to have higher asset, you won't be so asset light, a little bit asset heavier, higher working capital requirements as well. And as your working capital needs increase, relative to the level of sales you have, that costs money, opportunity cost. So that's going to weigh on margins as well. So I can make the case for lower margins, but I can also make the case that we are at a new mean reverting level, and I don't know that we'll see 6% anymore. You got to go back to where this mean reverting level is occurring, all the way back from 1950 to about 2000. That was a different world we lived in than it is today. Today we have far more disintermediated supply channels. So you don't have a manufacturer that then sells to a wholesaler, that then sells to a retailer, that then sells to a consumer. In the 90s, the internet really just showed up, 94, 95, and it was really just for, you've got mail, and that was about it. It really wasn't what it is today. Well, because what it is today, maybe you don't need a retailer, maybe you don't need a wholesaler. So you do have more disintermediation, which means that one company here is capturing the entire margin that would have been captured all along the supply channel, so that the manufacturer now has these large margins because of disintermediation. So maybe this is true. Maybe it's 6% when you have two companies handling a product, but if you only have one company handling the product, maybe it is 12%, right? Lower capital intensity of growth. If you go back throughout this period of time, especially going back all the way to 1950, and you look at the asset intensity of the companies in the S&P 500, you'll see that it's done this over the years, that they've moved from asset heavy to asset lighter and lighter. Some of that because of just-in-time inventory systems, some of it comes from working capital management, and some of it just comes from the nature of the business model, that a lot more businesses today are asset light, that don't require this large investment in assets. Diminishing marginal costs to scale. If you thought of traditional economics over this period of time, your marginal cost curve did this up to a point and it started to increase, right? Here's size, and as you got to a certain size, you had diseconomies of scale and your marginal costs would begin to increase. Well, now you have companies that have diminishing marginal costs to scale. When they add another user, there's almost no cost. It's cheaper and cheaper to add each and every user. A greater share of technology, not only in the companies that are in the index, but a greater share of technology in the index in terms of companies that are technology based. But even older economy companies that are in the industry have turned more towards technology, which also helps disintermediate supply channels. Less energy intensive growth as well. So even though energy prices are higher, each dollar of GDP actually uses less and less energy today than it did during this period of time when you had a 6% mean reverting level. Well, that's got to show up in costs, right? Also, you have businesses that have more network effects. And a business that has network effects, that means value is created outside of the firm that the firm can then capitalize on. So you can think of a good example of a network effect in the 80s or 90s would have been a fax machine. Nobody got any value from owning the first fax machine. It's only when everybody had them that suddenly the fax machine had value. That's a network effect. So that suddenly the fax machine became more of a need, that you really wanted one because everyone else had one, but that was only created by everybody else having one. That's a network effect. Where value is created outside the firm, but the firm then capitalizes on that. Well, if it's created outside the firm, the network effect has zero cost to it. So, your margins for anything that you do, your margins end up extremely high, higher than it would have been. So, look, I can make the case that we have entered into a new level, a new mean reverting level. So I don't know, even though I can say, well, we have all of this going on, I don't know that that's enough. I don't know that that would be enough. It might be enough to, contract margins, but 6%, I don't know that we're going to see 6% again. I think we might come back to the 10% level from 12% if there is margin contraction. So we're not going to know until we actually see earnings, but at least we know what we want to look at. Let's look at the growth in EPS year over year. How many companies are beating their EPS? How are they guiding? And what do their margins look like? I think you'll hear more of that on the Business News Network's A Bigger Story about, is there margin compression because of rising inflation? And if companies can rationalize this, if they have placed their pricing such that they do have pass-through, and we don't see this compression in margins, and even if we see some margin expansion, I think all talks of further downside can go away. I think the bear case gets harder and harder to make if earnings aren't going to make it for you. All right, let's look at the housing market. Here, there's a lot of charts to look at, and it's a hard story to tell without some kind of background into who's involved in this market and the economics of this industry. But we're going to look at some charts, and we're going to question a sort of rule of thumb that's been thrown out there, which has never proven to be true. Yet you hear it repeated again and again, yet the historical record says, no, that's not true. This is the ITB. It's an ETF that tracks home construction. Here are the components. D.H. Horton, you have Lennar, NVR, Pulte. You have Lowe's and Home Depot in here, Sherwin-Williams, because, you need paint, right? Toll Brothers. So it's all centered around home construction. On the next screen, we'll look at a broader index. This is down 31.16% from its 52-week high, which, it doesn't really say much. Maybe the 52-week high shouldn't have happened, right? Maybe this was, that was just really overvalued. So to say, we're off 32% from the highs is not as satisfying. 13 of the last 14 weeks we've been down. The ETF does have a dividend stream to it. And, the conversation is around housing prices are too high and mortgage rates are going up. So there's going to be demand destruction. And if you have demand destruction, you're going to have fewer building permits, fewer new homes built, and fewer new homes mean fewer materials required, fewer jobs that are created, fewer appliances that are sold. It has a huge ripple effect on employment. So that's why I said, let's dig into housing, because it will tell us it will sing first. It will, I shouldn't say sing, it'll confess first. Because demand responds outsized. When it comes to housing, you have outsized demand response because you don't have price response. You may be thinking, how can you not have price response? Of course you do. Nope. The historical record disagrees with that, and I'm going to show you that soon. Let's look at housing pricing index. We'll look at affordability here. DPI is disposable personal income. All of these numbers are nominal. Because pricing is nominal, earnings are nominal. Let's just stick with nominal. Why control for inflation, which is an imperfect measurement to begin with? Let's just stick with prices that we can observe. They're nominal. From March 2007 to February 2022, this is from Fred. This is economic data series from Fred. Disposable incomes are up 76%. From 10.4 to 18.36 in terms of, I think, billions, or is it trillions of dollars? You'd have to go to the chart on Fred and look that up. Just type in disposable personal income and you'll find it. And you can check the two dates, do the math. You'll see it's up 76%. The housing price index, we'll look at a couple here. This is FHFA, the Federal Housing Finance Association. Q1 2007, the index was at 380.86. The 30-year fixed was at 6.18. Q4 21, the index was at 557.53. We don't have Q1 2022, but the closest estimate was that over the quarter, the median home price is up 2.5%. So I just am going to say, add that up and put the index at 571. So the housing pricing index over that period of time is up 43%. And this is when we thought housing prices were ridiculous. The market was on fire. And we're up 43% from that period of time. And the 30-year fixed is sitting at 5.08. This is from Mortgage News Daily. So 6.18 is down to 5.08, but 380 is up to 571. So let's assume that we can buy a house for $380 versus $571 and finance it for 30 years at these rates. Our monthly payment would have been $232 back then. It is now $309. It's up 33%. And that's a combination of the index being up, but the mortgage rate being down. So as this increases, this will begin to increase. But disposable personal incomes up 76%, monthly payment up 33%, while the housing index itself is up 43%. So the mortgage rate does a lot of the price adjustment, not the house. The mortgage rate does the adjustment. And because the house is what is called a sticky price, I'm going to show you a chart for that. The house has got a sticky price. Demand has to respond and do most of the heavy lifting for adjusting supply and demand in the market. Okay, let's look at a number of charts related to the housing sector, and I'm using the site tradingeconomics.com only because I can toggle between charts really quickly. It's a lot easier than using Fred, where you have to load a chart every single time. Here I could just click on a button. This is housing starts. This is just before the credit crash, the housing crash, and look what happened here. If you go back in time, 1968, you had recessions throughout the 70s. Housing didn't get hit that bad. Here was the early 80s. You had that double recession, not that bad. Here was a housing crash in the 90s, not that bad. Look how bad this was. And then you have a climb back up, but it never really got back to these levels. This created a big problem. This created a huge shortage of homes in the U.S. And today, the big problem with pricing is that there is just a lack of supply of housing. Because you hollowed out supply for so very long, you had housing starts that fell way below what was needed for population growth, way below what was needed. And even though these have risen, you have to imagine that population has an upward sloping or an upward slope to it. It climbs, so that when you have this going on and this slow rebound, the population continues to grow, and demand is very tied to population growth. And employment growth, and you've got over 30 years you've had population growth, and even the last 30 years you've had more and more people with jobs. So there is a housing shortage. Just to give you an idea of how bad that housing shortage is, this over here created a massive shortage of houses, and even though you've had some growth in home starts, it wasn't enough to overcome the shortage. So let's have a look at total housing inventory. And this just gives you over the last year, but you can click on the 10-year. If you see how that's just downward sloping. Click on that's 10. Click on 25. And even click on the maximum amount of data series that you have for inventory. Look at where you are. That is just, you have a supply problem. Even if you have less than normal demand, you're still going to have a situation where demand is greater than supply. So you're not going to fix this problem with rising interest rates. What is going to fix this problem is the removal of a lot of regulation to allow a lot more homes to be built. I know that in the region that I'm in, it is not that easy just to buy a piece of land and throw a home on it. You can't just grab any piece of land. There's some big tracts of land available you can't build on because they're designated green zone. And that's it. You can't have those. So, if you want to be in a certain area, you can't expand certain areas. You have to buy an existing home, tear it down, and build a new one on it. There is just a general lack of supply in the market right now. When I bought my home here 3 years ago, I bought it below the asking price because rates were going up at that time. There was, some negotiating room. Even though housing prices were really ridiculous, I thought this is, I can't justify paying this price. Unbelievable that in 3 years my home has more than doubled in value. In 3 years, it used to take 15, 20 years to get that done. And if I look online now, when I looked for a home on realtor.ca, you're going through, 15, 16 pages of homes because each page has all those little thumbnail pictures. You got maybe 20 on each page, and there's a whole bunch. There's a page and a half now. There is no supply. Canada has a massive shortage of housing, and the U.S. also has a massive shortage. Look at this inventory. Now, if we look at a price level or a price index, let's see if we can find one here. Let's look at Case-Shiller home price index and look at it over that maximum period of time. Look at this. Straight up. Inventory, as we saw on the previous screen, straight down. This is straight up. Inventory straight down. Let me scroll up to get some distracting pictures out of the view there. Straight up, and the other one is straight down. That increase in housing pricing is really a big function of the amount of supply that's available. So here's the problem I have. How much are you going to have to raise rates to correct some of these markets? You're going to have to really, really destroy demand to bring it down to the low level of supply that exists. That's my biggest fear, is that the central bank keeps following the data, and the data keeps saying that inflation is here, price levels are bad, and if you just raise rates a little bit more. Meanwhile, it's a supply problem, and that raising rates isn't going to fix it. Existing home sales, if we click on that and look at the last 10 years, we're way up here. Yeah, they've pulled back from 6,500 down to 6,000, but they do, it's not a smooth series. They do that. Here's the last time that rates were raised. Look what happened to existing home sales. And then when they started raising rates again, up it went. So home sales are sensitive to rates. But as we saw on the previous screen, housing prices are not. Home sales are, but housing prices are not. Now, if the price would adjust downwards as rates would increase, you would have less oscillation in demand. But because it doesn't do that, the housing market has huge oscillations in demand. And this is existing home sales. Let's have a look at, what are we going to look at here that would help us out here? We'll look at new home sales, look at the 25 years. Still way below where it was back in 2000, 2005, way below. So we might think, yeah, but maybe everybody has a home. Maybe so many people have a home. That's why inventories are low, because demand just really isn't there. That's why this never really recovered, only because too many people have a home. But this was a big hollowing out of supply. Let's see if we can find anything of that, or if I'm going to have to go to Fred for this one. Construction spending. Okay, so I don't see anything on here for how many people have a home. So we will go to, at the very end, we'll go to Fred and have a look at that. We can click here. Let's look at building permits. That's a leading indicator. Building permits seem to be quite elevated over here. Let's look at the 10-year. Look where we are on building permits. That's a leading indicator. So housing, I think, isn't going to give us the same signals it used to give before, only because we have a definite lack of supply right now. As you saw in one of the charts, the inventory it's never been lower, and you can judge for yourself. Go online and look in your neighborhood or look in your region for what's available for sale, and what's there is the price you don't want to pay. And probably nothing really that suits your tastes. Let's have a look at home ownership now. Okay, so here is home ownership rate in the United States, and this is going all the way back to 1965, 62.9%. We're sitting over here at 65.5%, which is well below where it was during this period of time. Even from, let's say, from 1998, it was at 66%. 1998, it climbed all the way to, in the second quarter of 2004, 69.2, and then just began to fall. That got us way too low down here, but started to increase. But we're only at 65.5. I can see if this were really high, the highest it's ever been, then you could make the case that, well, listen, everybody who wants to be in a home is probably in a home. Home ownership has never been this as high as this. You would expect that there'd be less supply on the market to meet the lower demand because, you know, historically speaking, fewer people would be looking the more people that have a home. But that's not the case over here. I don't think that we're at a point where we can argue that, well, it's just there's no demand for homes because everyone's got a home. I don't see that. Okay, let's look at another indicator here. This is the HGX. It's an index. It's the Philadelphia Housing Index, which has builders in here, suppliers to builders like suppliers of lumber, appliance manufacturers, and mortgage originators. This is interesting to look at. This is the last rate increase. This is early 2018, and then the Fed started raising rates, and you could see exactly what happened here. And during this period of time, the 30-year topped out at 4.9%, and this was also the year that the market didn't do very well either. Now, this is not a pricing index. This has got builders, the suppliers to builders, appliances, mortgages. This is more real than just looking at a pricing index, because these are the suppliers to the housing industry. And yeah, for the whole year, it was just pain. All year long, it was just straight pain until they started lowering rates, and then okay, good enough, off we go, and then the pandemic hit. This, by the way, was not matched by housing prices. Here is the pandemic. Look what happened to housing prices. Absolutely nothing. It kept on going. Housing prices rarely adjust downwards. Rarely adjust downwards. The only time they adjust downwards is when you have a crash in housing combined with a credit crisis. That is the only time that they retreat to any significant degree. Typically what happens during recessions is you won't get much price increase, but rarely do you get price decreases. And this showed you, look at this whole event in here. You know, straight down. We recovered quite nicely, but housing, if I just showed you the housing pricing index for the US, and I said, I want you to draw this gray line over here. Get a better color here. I want you to draw this gray line. I just gave you this. Draw this gray line of where a major downturn in the markets and the economy happened. Where would you draw it? You get no information from this. So, you know, when you have price times quantity, and suddenly the demand for quantity starts dropping, typically you'd see the price drop, which would then increase the demand for quantity. But in this case, you have a price that does not drop. It pretty much has a one-way trajectory. Which means that if you have a drop in quantity, it has to completely be absorbed by a drop, it is completely as a result of a drop in demand. There is no offsetting. We can't say, well, you know, if prices didn't adjust, demand would be even lower. So demand oscillates a lot around housing. But I'm not seeing that in the building permits. I'm not really seeing that in the housing starts. I'm not seeing that it's falling off at the rate at which this index is falling off, which means, could it be wrong? It has been wrong before. That big drop off in 2020 was not matched by the housing pricing index. So it's not as if the price of the house is lower. The only conclusion we can reach is that it must be the demand for the housing that changes. Under normal conditions, I would say that that is correct. But we are supply constrained. So I don't think that we're going to see very much turnover in building permits, in housing starts, and I think that this index is thinking too linearly. Oh, well, rates are going up, so the housing sector is going to suffer. Traditionally, yes, that was a true statement. The housing sector would suffer because prices don't want to adjust. So they tend to have these big cyclical moves. I don't think price is going to adjust again. I think that most of the damage from what the Fed is doing is already in rates, and I think now we're probably going to go sideways on rates for a while till we see what the Fed does. The big threat is the Fed thinking it needs to raise rates just a little bit more and just a little bit more and just a little bit more because the data isn't coming its way. I think they're smart enough to realize that there is a big supply component that is the problem here. And that, shutting down demand, unless you're going to put the economy in a recession, I don't think you're going to do much to certain sectors. Down here, this is population growth for the U.S. in 1990 to 2022, 250 to 330 million. So you have population growth that happens all the time. So you need homes that are being built all the time to match population growth. Well, remember what we showed you after 2008 is home construction did this and stayed low for a period of time before it started increasing to about here. Meanwhile, you got population growth that continues, that has a positive slope. So, by the time you get to this, even if you raise, you got to get past the last peak just to keep up with the growth. What's in favor is the growth rate. In 1990, population was growing at 1.6%. It is now growing at less than 0.4%. That's a big problem going forward for the U.S. That is a big problem. It's going to have to be solved somehow, and it's going to most likely have to be solved with higher levels of immigration because you can't let that flatline or even go negative. Once you get a shrinking economy, it's hard to turn that around, and a shrinking economy is never good for the future of that economy. So you're going to have to do something on this end over here. I think that there should be more policy looking at that, saying this is a problem. Central banks are worried about deflation. Countries should be worried about negative population. I shouldn't say negative population growth, just a shrinking population. But here's the problem with housing: is there is a big gap, and I don't think we have price signals here anymore. So I don't know what I can read out of this, unfortunately. I said I would make the bear case for markets this week, and I really can't make too much of a bear case. I need to see earnings, and if earnings come in as expected and even continue to beat, even 2-3% beats, if earnings come in that particular way, it's going to get harder and harder to make a dent in this market. If inflation, we get a CPI read coming up this week. If inflation starts to moderate due to the rolling off of base effects meaning that we have a higher and higher comparison for last year, such that the growth month over year for that month doesn't look so great because the base effects were higher. If it starts to moderate that way, the expectation of the central bank raising rates too fast begins to drop. I think you could maneuver your way out of this if we believe that supply, given time, can come back online, that supply issues can resolve themselves. I think we're going to be okay. What follows from here is a conversation between Dave Harper and myself. He's been a long-term investor in housing stocks. I've never owned a home builder, whereas he's a lot more familiar with home builders than I am. So we'll listen to what his take is on the outlook for home builders and how he thinks they're being valued. So what is before I go? What is my takeaway for markets here? At this point, I can't see 52-week highs happening anytime soon. I don't think we're going to see a 52-week high this year. But I also don't think we're going to see new 52-week lows this year. I think we're range bound. I think they're at a certain point, there's really no compelling reason to go higher. And at a low enough point, there's really no compelling reason not to own the index if you're willing to look past 2022. It's I'm data driven. I know this is unsatisfying to hear. I don't have any real strategy at this point in time other than to say, let me see some of the results from earnings. I need to see some of that stuff. I need some clarity there. Let's see the CPI print this week. Let's see what the Fed is thinking. And, earnings could carry the day. And if earnings carry the day, then, I think we're good. Anyways, I hope you enjoy the rest of the video. I do this all the time. You invest. I mean, you have home builder stocks. Which ones do you have, by the way?
Well, yeah, my biggest position is in Lennar. So they're one of the top three large. They're the large caps are Lennar, DR Horton. I saw you showed your exhibit there. I have Lennar, that's LEN, DR Horton, DHI, and I don't have the other large cap is Pulte Homes, PHM, and I have a small cap Taylor Morrison, TMHC, Taylor Morrison Home Corp. Uh, but Lennar is the one I've had for the longest, and I have some special reasons for that. We talked about home builders before. It's hard. A lot of investors think they're all the same, and they do tend to trade alike. But I think there's some special properties to Lennar. They're for example they're easily the most tech forward of the home builders. They're going to spin. They have a corporate venture, Linux. They're going to spin that later this year, third or fourth quarter. Because I like to have. I'm basically value CFA trained, but I like growth too. So I like both value and growth, and then I like to have an embedded option. And with Lennar, they've got that really strong corporate venture. They've got investments in all. They're playing in all of the disruption around home builders. They got a stake in Open Door, Blend Labs that's disrupting mortgage underwriting. So, as far as I can tell, that's not even built into the share price. So that's easily a few dollars there of embedded option on Lennar. So they're large cap, great management, and
I
yeah.
find I find the market is reluctant whenever there's legacy and something new. The market seems reluctant to give legacy any respect for doing anything new. For example, GM is probably leading in autonomous vehicle technology with Cruise, and it's accelerating its EV, but it gets no respect. It's not even remotely even being priced to have anything to do with that. So it's no surprise that the home builder's not getting any respect for trying to be, to have a foot in both worlds, in old economy and new economy.
Yeah, well, they don't even notice, and we traditionally we talk about, what should a corporation do with excess cash? We've in the CFA, it's you dividend it or you buy shares, and so this whole controversy around share buyback. But in this, when every quarter I go through my companies and the earnings, and there's two themes that literally every one of my companies has been hitting on every quarter for several quarters now. The first one is ESG, whether perceived or substantive. And the other one that I actually think is very substantive is digital transformation. Look at any company, every industry, they say we're doing digital transformation, and I actually think in a lot of my companies it's a sincere effort. And so, the other thing a corporation should be doing, if you believe we're in this special age of digital transformation right now, aside from like returning capital in the typical ways, is to be smartly have a corporate venture arm, be smartly investing that, which is what Lennar does. So they've grown that book. It adds volatility. In Lennar's case, it's like a $500 million swing on the quarterly that they have to sort of explain. If you're afraid of quarterly volatility, you don't like it. But otherwise, I think that's what you should be doing with some of the excess cash.
So maybe it's just a case where the investors that like low volatility, that like Lennar, suddenly don't like all of this volatility, so they decide to leave. Whereas the young ones coming in are saying, "Well, I don't like this legacy stuff because it's holding down the volatility that I would really like to see," and it's sort of in this middle where can't get a date. Does Lennar build on spec, or does it just? I think there's a couple of home builders that don't build to spec, and there's some that build spec. In other words, they'll hold inventory so that they have supply, and there are some that don't have supply at all.
Yeah, well, they do. They're all moving to a. That's the other thing. It's a little like the banks. They're getting treated. I feel like banks and home builders are getting treated like back in the crisis. And in fact, the banks are different now, and so are the home builders. They've all. I think NVR might have started it, but they're all shifting aggressively to asset light or capital light strategies on the lots. So I think DR Horton is actually now over 50% where they're controlling the lots instead of owning the lots. And so this is, they and it's one of the spin-off companies in Lennar's Asset Light. They're partnering with investors who are basically buy the lots, and then they're going to write Lennar. They write the home builders an option on the lot, so they're optioning the lots. And I would expect this will. I would think this would drive up, price to book. A traditional measure for home builders that like Bank of America is now going to swing back from PE to price to book on the home builders, which I don't, is not my thing at all in this environment. But I think they think it's a cyclical peak. So yeah, they're going asset light. I'm not sure if that addresses your spec because I don't really focus on the spec side of it. I mean, there are a lot of them. They're really they talk about communities and flow through the communities. So I think one of the big trends is master plan communities and increasingly like built to rent. So, like Taylor Morrison, which I really like, they partner with Christopher Todd, and they're building for Christopher Todd. Then has gated communities, and they're basically I think they call them horizontal apartments. So they're basically building the houses so Christopher Todd can rent them, but they're detached houses because in the rental market, what's really appealing is that they pick up some of these people who would have been buyers, but they'll rent a house if it's got a private yard and a pet. Right? A private yard and a pet policy detached. That makes that makes it very appealing. So on these, they've a big part of the demand or growing part of the demand here is the institutional buyers and build to rent. And the institutional buyers include like the publicly traded, like Invitation Homes, single family, American, these SFR REITs that are part of the demand. So the demand, I like as you mentioned, there's just no end. There doesn't seem to be any end to the demand.
Yeah,
and
well, when you look at that chart of inventory since 2010, it's going straight down. If you look at the history of inventory levels of homes available, and this is a sort of a conundrum here. You have the lowest inventory levels you've ever had, but when you look at a data series that says months of supply, it's pretty much normal, that you pretty much have normal months of supply, 6 months of supply. So you hardly have any inventory out there, but you apparently have 6 months of supply. So the actual demand out there must be lower over the last 10 years as well, which if you have rising prices, you should have lower demand, and it looks like inventory has reduced to meet that demand. Perhaps what is contributing to the lower levels of inventory, but keeping prices high, is all of those deals where that inventory never even hits the market, where you have a lot of home sales occurring that support the price in the market, but they're never inventory. Much like my friend who has a dealership, when they order cars, they never go into inventory. They come off the truck and delivered to the consumer right away. So if you ever look at their inventory level, there's no inventory, but their sales are there. So that inventory levels look low, but that doesn't affect sales because the asset never actually makes it into inventory.
Well, right, and anecdotally, that's certainly the complaints. I'm here in California, that's certainly what you read about and hear about. And on top of that, companies like, Opendoor, the iBuyers, like Zillow had that's the business that Zillow got out of, but Redfin is still in. Opendoor is the biggest player. They're basically, trying to disrupt by creating an exchange in the buying and selling of homes. So they're creating liquidity. So that's another source of pulling the home outside of that traditional sale. Very appealing to a seller. But I've talked to people, it's a really compelling value proposition with Open Door. They basically say, well, here, they run machine learning on the price. So the price is very important. They get pricing right. They say, here we'll buy your house. It can be done in a few days. So you don't have to go to you have to go to the staging. You don't have to go to people walking to the house. You don't have to do the dreaded thing of, well, if it doesn't sell in 30 days, I got to bring the price down. I got to sit around for 60 days.
That didn't work out too well for who was doing that? Zillow, right? That didn't work out too well for them. They had to stop it altogether. I guess their algorithm was wrong and they were paying the wrong prices in the wrong cities, and they took a big hit on that one. That's kind of like the next iteration of FISBO, the for sale by owner, because the for sale by owner has been around for a long time, where you buy a kit, you list it yourself, and it gives you everything and costs you $1,000, but you don't get you never got the access to the realtor network where buyers could see your supply. Unless buyers looked for that particular supply, they would never see it. Just another example of that, disintermediation from the builder all the way to the consumer, that they're hopping over the entire channel so you can keep those margins there. What
Right.
of the companies you have any issued any guidance?
Well, yeah. Well, right. This goes back to I think we talked about this or chatted this, and or at least with some of your followers, maybe, because sentiment is obviously not good on the home builders, especially in
Neither with the
places.
automakers. Neither with the automakers. I'm suffering there.
Yeah, yeah, but Mark, but that this is what I train for, right? The CFA and all of the stuff that we do. So I train for great fundamental profile and negative sentiment. I feel like, and it's important to say, I'm not trading. As I told one of your followers, I wouldn't be trading home builders in the next 2 quarters, given the uncertainty around the mortgage rate and affordability. Of course, I take a 3-year horizon. And so, no, to answer your question, no, there has been no, well, we came coming off Q4 for the three I have, although the two mega cap are most interesting because they have economies of scale in light of the supply challenges. Like Lennar is a big company. I'll tell you, the supply problems, with HVAC and garage doors, the supply challenges for home builders is what I'm least concerned about with my large cap home builders. They are all over this problem. Locally sourcing, on their supply chain. Um, but given the concern around the affordability and mortgage rate, and like you've showed or will show some historical patterns that are not favorable here to the Fed tightening and home builders. But co- what I like to do, I analyze the company's CFA style, and I very, I make sure I read the quarterly reports and quarterly earnings calls and really pay attention to what management's saying. So coming out of Q4, which is only a few weeks ago, right, that they really reported, it not a whiff of genuine concern, right? And of course the analysts are really scratching that to see if they should be worried. And so this is that Q4 report came in after the inflation and when we knew what the Fed was started with. So it's well into the what the built-in negative sentiment, that negative 30%. When you bring down historically the price to book about one, and the PE ratios on my home builder is about five. I think Lennar may be even a little less than five. It's about half the historical. You've got a lot of the negative sentiment built in, and then meanwhile, uh, not really a whiff of concern, and certainly no interim concern about the buyer. Taylor Morrison, that's the smaller one. They watch this very carefully. So some fascinating things they've reported to me. They track uh, the qualifying buffer minimum affordability spread. So basically, on their conventional loans, how much could the rate increase and they'd still qualify? That last reported spread was 700 basis points.
Yeah, I remember hearing something about that sensitivity analysis was done somewhere in Canada as well, and I forget who did it, but it was like 300 to 400 basis points higher that the rate could be, and the people who qualified for mortgages would still qualify for mortgages. So
Right.
I think historically, even at 5% for a 30 year, that's still quite low for a 30 year altogether. It's just housing prices are so much higher, but disposable incomes are also that much higher as well.
Right. And also, they look at back end ratio and they survey it qualitatively, right? So as far as I can tell, the 5% mortgage rate's not a problem. Taylor Morrison isn't really concerned till 7%. Some of the others, 5.5, 6%, where they start to feel, where they say they would start to feel pressure, in particular with the first time home buyers, right? You divide, it's basically first time, move up, and then the active adult or 55 plus. The active adult and 55 plus, they buy into the new houses with a equity cushion on the house they're selling. So, I really like that active adult space, right? I mean, there's just not going to be any slowdown, especially like and Lennar's in these great areas, right? Of course, it's regional, but here in the U.S., Florida's on fire, just on fire. Several cities, Atlanta, uh,
You gotta qualify
Miami.
that these days. When you say on fire, it could literally be on fire, right?
Sorry.
I mean, California is not immune to being on fire as well. So when you say Florida's on fire, you mean it's a hot housing market, or it's literally on fire?
Yeah, good point. Yeah, sorry. Yeah, Florida has several cities where like Lennar is the leading home builder, and the demand is basically insatiable. We'll see what they see on the next quarter, but no concern in terms of leading indicators, wait lists, affordability. So yeah, I just meant, yeah, hot market in terms of buyer, and a lot of what's driving that here in the U.S. I'm sure is migration trends, right? The I'm in California, where the migration out to, in particular, Texas is the hottest country, and then within hottest, Texas is the booming state, and then Austin within that is I think, according to some, that would be the fastest growing metro. But so you have Texas and Florida, both states with no income tax. Even in So Sun Belt,
No state income
no
tax.
state income tax, no state income tax. So we get a lot of migration to Texas, to Florida, Atlanta, and then even here where I'm California, it's so a lot of net migration out, but it's really from the coast to inland areas where Lennar is also strength. So that migration, which is somewhat assisted by the pandemic and work from home trends. Where I am, it's over average sales price are over 1 million, but there's no inventory at all. But so coming from the coastal, you can go to these areas and you can the average the house price is cut in half or a third into these local markets where they're feeling like the prices are going up, but on a relative basis, migrating from the coast, the price is going down.
Yeah, this neighborhood as well. When I first moved here, it was this house and four others. There are no for sale signs in this neighborhood at all. There is, if I wanted to sell my home, there's nothing to benchmark it against in this neighborhood at all. I can't even see what other people are asking. There is no inventory at all, and I think for the first year I was here, there was always a for sale sign somewhere. This one here or that one there. There's none. There's been none for quite some time. No supply in this particular neighborhood. I want to go back to something you said about the pricing. We know that they're off. The home builders are off some 30 to 35%, 36% off the highs. But being off the highs, big deal. Maybe the highs shouldn't have been there. what when you say some of them are trading price to book versus PE, do they have a mean reverting price to book level that they return to? I imagine they would have a mean reverting price to book level. And are they below that now? Are they near that? Where are they in relation to their price to book?
Yeah, I've never been a big fan of price to book, even, I know they look at it in home builders. I thought I've read it's 1.1 or a little above, a little above 1.0. And I think it's a little elevated still. And, it correlates with return on equity, as you would, right? As that's how so higher ROE to price to book. I sort of think, if given what they're doing with the asset light strategy, I'm sort of thinking that high price to book is actually would be a good leading indicator of a quality home builder who's participating in the asset light. So yeah, yeah, they do. I think it's a little above. I know that some institutional sell side, thinks that that's part of the narrative why it's maybe peak cycle. Um, but yeah, not. I'm not concerned about that. I'm sort of. I like the fact I like forward PE is. I like the fact the forward PE is about half its long term average.
How can you assess the forward PE going into the environment we're going in? Do you believe the forward guidance the company gives? I'm skeptical. I know there's a forward guidance. GM has reaffirmed their 2022 earnings and they've given forward guidance, but based on people I've been talking to in the industry, it's supply is never been worse. It's not that it's getting better. I'm hearing it's never been worse. This is the worst it's been. That I don't know that I believe their forward guidance at this point. So to say that it's ridiculous, GM is trading at 5.5 times forward earnings for a company with the cash flow and the operating margins it has, it doesn't make any sense at all. But I have to step back and say, well, do I believe $7 in earnings over the next 4 quarters? I don't know. Do you believe the forward guidance of the home builders?
Well, I don't focus on the forward guidance of earnings or earnings per share. However, if in case of Lennar, like DR Horton, the top line guidance has been pretty reliable. And to my largest position, it's been somewhat conservative, right? So they're guiding 25% revenue growth, uh, over the forward fiscal year, which I guess we're 1 quarter into it. Um, I do think that's yeah, I do count that, and we'll see if there's any moderation in it. And the margin, I think a lot of the reason the sell off is that the you can see the institutional buyers, the institutional sell side research office, they've all slashed their price targets on the home builders. But by at least what they're down 30%, those price targets are down 30 or 40%. And although those slashed price targets are generally still above where the prices are now, and mostly they're anticipating margin compression. So, fantastic. It's 300 basis point increase in gross margins coming out of the last year over year on the last quarter. So they don't believe there will be. I don't think anyone believes that these phenomenal gross margins will necessarily be sustained. They certainly won't grow. In Lennar's case, it's a rule of 50 company in the sense that you just take the simple rule of a growth and growth plus forward growth plus gross margin. Add that up, in the technology SaaS company, the rule they like to see rule of 40 is pretty good. Well, in ours, a rule of 50. It has a revenue growth of 25% and the gross margin of, I think, 27%, which grew. And but a lot of if you look at the last call, a lot of the slashing of the price targets, and a lot of the questions is around, what's going to happen to your gross margins, affordability. Can you really keep the price, what's going to happen to price. So they are guiding price appreciation, double digit price appreciation. um,
The price index that I showed shows that it doesn't retreat in recessions. It doesn't at all. The housing price index stays the same unless there's a credit crisis. So the only thing that could hurt, I don't know that you'll hurt the gross margins. I wouldn't say that, oh, I don't believe 25 or 27 on gross margins, but I might not believe 25 on revenue. That I might think maybe revenue might take a hit. But with inventory as low as it is, with turnover where it is, agents tell you like your house will go in the first week. Like if I listed my house, it would be gone in 4 days. Even if I listed it at double what I paid 3 years ago, it would be gone in 3 or 4 days. The average housing price in this market has gotten unrealistic. And they don't stick around. A couple of them sold even without hitting the market. That the agent just knew buyers, and that was it. That was it. So
yeah.
it could be that and I've made this case before, that if demand for something is 300 and you have 100 of them, and the Fed raises rates and 50 people leave the lineup, you still don't have a balance because you have a supply problem. Now, if you didn't have a supply problem, but you had a demand problem, rates could fix that very quickly. But when you have constrained supply and even normal demand, not even outsized demand, normal demand but constrained supply, rates aren't going to do much here. So I don't think that higher rates are really going to slow down the housing market. I see drops in mortgage applications, but a lot of that heavy lifting is done by the refinance. You don't refinance when rates are going up. So
Yeah.
when I see the mortgage applications drop, I think, well, duh. I mean, I'm not refinancing at 5% if I'm locked in at 4% or 3%. So that will lead to some mortgage declines. But building permits were up. I'm looking at housing starts, and I don't see them rolling over.
Permits and starts, uptrend. And staff just flabbergasted me. Taylor Morris, that's my small one, my small cap. They have a higher average selling price, really quality homes. In the last quarter, they said 50% of their buyers were cash. 50%.
Yeah, well, I bought cash. You almost have to go in. Well, when they say they're cash, it means that they've already been pre-approved. I don't know that 50% are actually paying cash, but 50% are probably going in with no financing conditions, thereby being cash, because before you
Oh,
go
okay.
shopping for a home, you're going to get pre-approved. You know you can spend 1.2, and this way here, when you make your offer, there are no financing conditions, not conditional on financing or anything like that. You could just make a cash offer because you know you've got it. You've been pre-approved, and off you go. But 50% being pre-approved, uh, um, you know doesn't sound to me like a market that's ready to turn over. And just from what we're seeing in our region here, and we have fairly high mortgage rates, just like the U.S. Our Bank of Canada is going 50 basis points this week. That's pretty much a done deal. While I'm uncertain what the Fed is going to do, we're pretty sure the Bank of Canada is moving 50 basis points. There is no slowdown in the housing market at all. Toronto had a slight decrease in price, but that slight decrease in price didn't come from listing at a lower price. It came in from offers not being so excessive above the asking price, but still above the asking price. So, but that's Toronto. In our region here, you list something, it's just gone. Like there is no supply. I don't think that I'm getting much of a bear case for the equity market out of housing. And I think that part of the sell-off is simple linear thinking. Houses, mortgage rates are going up, prices going down. I certainly don't want that. Meanwhile, the record shows that prices have never gone down except if it was credit induced. That's the only time housing prices have ever retreated in a recession, if it was credit induced. Housing tends to do very well when inflation is very high because the replacement cost of all houses go up. So all houses will increase at that rate of inflation. So I can't make the bear case for housing prices at this point in time. I can make a bear case for housing demand from first-time buyers. But I can't make it from someone like me who sells here. I can go to a smaller market, get a smaller house, and probably pocket 500,000-600,000 on the exchange if I don't need to live in this area anymore.
Right.
And somebody coming into this place has either got good parents for a first-time buyer, or already have, as you say, an equity cushion, and they don't have to take a 30-year. They can take a 5-year fixed. They can have a 25-year amortization with a 5-year fixed, a 10-year fixed. If you have any kind of financial acumen at all, you'd probably lock in a 5-year, because 5 years from now, this will be over. I don't believe that we live in a world of inflationary pressure. I think that we live in a world of supply-induced inflationary pressure, only because capacity in almost everything is almost unlimited these days. And we don't make as much stuff as we did 30 years ago in terms of our disposable income. We spend a lot more on experiences, and there's unlimited experiences that we can spend money on. So I think most of this is supply induced. And I know my video this week was making the bear case on equities, and I am having a hard time. I mean, I can make the bear case based on linear thinking and sentiment. Like throwing out, like GM last week was trading below book value. It wasn't even trading for a multiple of earnings. It wasn't even trading for asset value. It was trading down towards its liquidation value. Only because, well, legacy, 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 and all of this idea about legacy. Without thinking that, well, hang on a second, it has a foot in both ponds here. It's all linear thinking. You have to think non-linearly, much like the companies that you're in. They are in new world technology as well as in traditional house building. Houses are not going away. They're not going away. They're not
No,
going away.
no.
You can't outsource houses. They're not going away. It doesn't, and to throw all of that out, I think, when the data does not support falling home prices. Now it does support falling demand, but I'm not seeing falling demand.
No, I think you covered it really well. I agree with all that. Sorry, I can't help you with the bear case more because
Because
going
you're
down
long,
my list,
because you're long.
you left you left out demographics, but I think that helps the bull case because of the you got millennials and that household formation looks favorable for several years. I even would go further on with my home builders. I think they could afford some price moderation. The guidance is they've outpaced inflation. The price appreciation guidance is double digit, 12, 13, 14%. I think these are still great investments, even if there's pressure on the pricing. So yeah, it's interesting. Supply demand. I was thinking about trying to understand housing in terms of supply demand. And I think it sounds like we're agreed that the sentiment or the concern is a shift in demand left, so to
Well,
speak.
yeah, well, that's it. Demand responds. Demand has to carry the whole load. Price doesn't do anything to cushion demand. It doesn't drop to lower the thing in demand. Pricing stays on this trajectory upwards even through recessions. House pricing continues to go up, and as mortgage rates go up, demand has to take the whole brunt of it. And I think that's probably how they're thinking. However, we
Right.
are we are this is not a normal period. We are supply constrained. The recession after 2009 created a massive shortage in housing because housing starts dropped off and stayed low for 3 or 4 years before coming up. Meanwhile, population growth still continued on, and I do include demographics. 1990 to 2022, U.S. population grew from 250 million to 330. So you do have roughly 33% more people over 30 years that need homes than you did in 1990. However, here's the big problem. Population growth in 1990 was 1.6%. Population growth now is less than 0.4%. It's less than 0.4%, and there's a housing shortage. If there is any increase in immigration, if there is any increase in population growth, that's going to get squeezed very quickly. And that's the problem, the big Canadian problem for a long time, is housing pricing was driven by immigration quite significantly. So we still have high levels of immigration as a proportion of our population, much more than the U.S. But even though we have more land, you can't. A lot of the land you can't build on. It's not conducive to
Right.
infrastructure and building on. So it's pretty much dead land. So we have in Canada probably the biggest housing shortage we've ever had. So I don't know that I can make the case that we're going to have a housing-led recession. I simply
Yeah,
can't make the case.
and it's funny if we're talking about like almost any other industry like technology, we would be talking about, oh, the competitive, who's got a moat, and given this undersupply, who's going to come in, and change the supply curve. But in housing, there's not the case.
No, I don't
There,
think so. And housing, again, housing is not something you can outsource. I don't think, okay, well, 3D printed houses. I've heard that this is sort of a thing, a 3D printed house, but you still need to buy the land. You still need to situate something on the land. You still need to connect it to all the infrastructure. That's all employment. Every house, every building permit is a leading indicator for a house, which is a leading indicator for employment. And I'm not seeing that roll over anywhere near the levels. In fact, they're pretty much at the same levels now, even though new home construction is well below what it was in 2005. If you look at the future indicators in terms of building permits, they're at the same level they were in 2005, 2006, when all of that was really expanding rapidly. But the difference between that period of time and this period of time is the previous period didn't have a hollowing out of supply. It didn't have that hollowing out of supply. Supply continued to grow. Only after the great financial crisis, supply went like this for about 4 or 5 years and then started to come up. That hole right there. Meanwhile, population still continued on. You got to catch up to that rising number. And I'm seeing it pretty much anywhere. Just go on any realtor site and have a look at what's available. I mean, you don't have a lot of selection. It's nothing much.
And as far as substitutes, right? The rent goes up rapidly in the meantime, making it, the ability to substitute to rent is not compelling either.
No rents are going up. Try to find a house. I mean, try
Yeah.
to find a house, right? Anyways, you have anything to add? Anything that can
No,
help me make a bear case here? I know
well,
you're long. I'm long too, and
yeah,
it's hard to make a bear case when you're long. But I mean, we can always sell calls. We can always do a whole bunch of great things. We can always profit on the way down. And the thing is, we want to be true to what the data is telling us.
right.
I'm having a hard time. Help me out. I mean, I can make a somewhat bear case, but not as good as I can make a bull case. In other words, if I had to choose right now and I couldn't look at my portfolio for 5 years, I'd be long and strong.
Yeah, I guess the concern is the consumer is affordability. Do you buy and that, I mean, that's a question for you. The price, the prices have gotten very high. The affordability index, I think the NARs, I think it's come down, but it's still at 140% or so. Um, do we as long as there are consumers with good well-paying jobs. I mean, I sort of think the economy is at least two it's got two tracks or more. And a lot of people have been hurting for a long time, but in these upper tracks, people with tech jobs in these urban areas where like Lennar is, these that are growing fast. The fantastic jobs, consumers seem flush with cash. Gaming.
There, yeah, you have this labor shortage. You have wages that are increasing, disposable incomes that are increasing, and um, uh, you know, uh, when we think about affordability, we tend to think about the expense of something, and that's how we look at affordability. But we're talking about affording what history has shown to be an appreciating asset that will perform in line, if not beat, the rate of inflation. So, when a real estate agent says it's never been a better time to buy, at every point in history, they were absolutely right.
Right.
They were absolutely right, except 2007. They were wrong in 2007 because there was a dip in price, but then it quickly recovered. Once the rates came back down, it quickly supported housing prices, but they had that intention. But going back through the 70s, back through the 80s, even with the inflation in there, housing prices still continue to go up. So whenever I hear a real estate agent say it's never been a better time to buy, I always think, this is just something you say no matter what is going on. But history has shown that has always been a true statement. So what does it matter about affordability when you are buying an appreciating asset over a long period of time? And if you buy, and incomes tend to go up over time, housing prices tend to go up over time, but your mortgage balance will decline over time, so that the spread between those two will increase. So I don't know so much that the economics of the housing market, when you have a supply constrained market, really matter anymore. I don't think it matters, and I can't get very far. I thought if I head down this road, things would just come together. But the more I kept looking at things, the more I kept thinking, I'm not seeing it. The data, the history doesn't support what the analysts are sort of throwing out as linear thinking. Oh, you want to be out of this, you want to be out of that, you want to be out of this. In normal times, yes, but not in a constrained supply environment. So I think these rate increases are a little bit more hawkish than I think they should be. I don't think that they're going to solve the problem of supply. You can't. I mean, you have to basically throw the economy into a recession to get demand below where supply is today. Now,
Well,
how do you restart all that yet again? It's a dangerous place to be. Maybe that's the bear case. Is the bear case is a huge policy mistake in front of us from rates going up way too much, from forcing the economy into a recession that it's barely trying to get out of because of supply constraints. Coming out of the next one could make supply constraints yet even worse. Maybe there's my bear case. There you go.
well, I mean, inflation? I mean, I underestimated inflation, and it feels anecdotally it scares me more than the statistics. So, I mean, inflate food inflation, energy inflation. I guess home prices are not included in the. I never quite understand that. I don't think they're in the headline inflation, but uh, home price inflation. So, I mean, if there really is sustained inflation, um, then and the Fed does overreact and try to really throw us into recession, that would be a problem, wouldn't it?
Multi-year problem. Yeah, that could be a multi-year problem, and it could potentially be as much as a 50% retracement on the S&P. You might even see, the twos if it goes on for any significant period of time. That is about the only pathway there, but the underlying economy is strong, which means the recession isn't around the corner. The yield curve is no longer inverted, and even when you do have an inverted yield curve, it has to be significantly inverted, and it's usually a prediction of a recession, 2, 3 quarters out, not right away. So I don't know that I can, for the rest of the year, make a bear case on the market. We'll have to see what the Fed does. And I think the best thing that can happen is inflation begins to soften, whether it happens through base effects or whether it happens through, supply coming back online. The biggest problems in the world right now seem to be constraining supply, not constraining demand. Russia, Ukraine, well, that takes a whole bunch of things off the market. We have to look at different places for things. Semiconductor supply. I mean, the reason we're not selling more cars and more people are employed in that industry is it's limited by the amount of semiconductors you can get. People tell me Tesla can sell every vehicle it makes. That's why its price is where it is. Yeah, but so can GM and Ford. GM sells every vehicle it makes. There's no inventory. Acura sells every vehicle it makes. Honda sells every vehicle it makes. Everybody's selling every vehicle they can make. And in fact, many of them are making vehicles without chips in them and just putting them in the parking lot saying, well, when the chips come in, we'll do that. But here we are. This is the situation we're in. And you can measure inventory in the system now in terms of hours. It used to be 50, 60 days of inventory. Now it's hours. How are rising interest rates going to change that? You need to change the supply dynamics. You need not raise rates, but invest in more supply. That's where I think the focus should be going. So maybe there's my bear case is that that raising rates isn't going to do anything, which will then convince the market or push the market into thinking they're going to get even more aggressive. And that in itself will take the market down.
Interesting. Well, okay, let me ask you. I'm not too concerned about the Fed raising short term Fed funds rate, but I feel less equipped. I feel less equipped to understand the balance sheet, and the tightening as it relates to shrinking this unprecedented balance sheet. Is it possible that their balance sheet could really send long rates up? And then the spread on the 10-year to mortgages to 7 or 8%. That is definitely a 7 or 8% mortgage, 30-year mortgage rates is definitely something the home builders aren't planning for.
Yeah. So when they were building their balance sheet, they were generally a price insensitive buyer. So as a price insensitive buyer, it didn't matter. It didn't matter how negative real yields got. It didn't matter where rates were. It just didn't matter. They weren't buying for the return. They were buying for yield curve control. They were just price insensitive. They didn't care. They're going to be letting rates, coupon bonds run off. And if not enough run off, they're going to let T-bills run off up to 60 billion a month. At least this is what that was in the minutes, which means that bond, they were rolling that over. So whatever coupon bonds they let roll off the T-bills, well, that's the lower end of the curve. That's already responded to. It's already over responded. But on the longer end, let's say 40 billion rolls off, they'll fill it with 20 billion of T-bills. But now you have 40 billion that won't roll over. You don't have 40 billion of a price insensitive buyer. You have price sensitive buyers now at that end of the curve. However, the 20-year now has a positive real yield, the 30-year now has a positive real yield, and the 10-year probably will see a real positive yield before the end of April, because it's sitting, I think, I forget on the presentation, or 15, 16 basis points below zero. You're going to have a lot of pension funds that look at that and say, why not lock that in right now? That's good for us. That immunizes this part of our portfolio. Let's grab that 10-year. Let's grab the 20. Let's grab the 30. You have, if you think about it in terms of preferred habitat, you got a lot of life insurance companies that hang out at the 30-year. You get a 30-year pushing 3% without the risk. Why not take the 30-year? So I think, as you get to certain rates, money will be drawn to it. Global bonds are dropping as well, and money today finds its way around the world a lot faster than it did 20 years ago. And there's a lot fewer restrictions on funds in terms of what country exposures they can have. So you can buy European bonds, German bonds, which the 10-year is still nothing, or you can buy US bonds with a strengthening US dollar because rates are going up, and a central bank that's going to be a lot more aggressive than the ECB. So because money has to go somewhere, you can no longer think of assets as, well, what is that asset worth on an absolute basis? You have to think, well, what is that asset worth on a relative basis to other assets? And even on an absolute basis, I don't like the price. On a relative basis, I got no problem. So a lot of the negative real yields were not a concern to credit investors because they were isolating the credit spread. They couldn't care less where the real yield was. They were isolating that credit spread. Who cares where real yields are? You got a buyer who's insensitive to price, so let's go to credits and play, and we'll work on the spread. Well, those spreads have increased. Even though the fundamentals of the companies have not, that's only going to draw money back in. Again, on a relative basis, where are you going to go? What stock market in Europe would you choose over the US? Or Canada, for example. Canada's market is not negative for the year, it's positive for the year. Or did it just turn slightly negative on the close? Because we're materials and energy. So right. we are positive for the year. So that's just going to attract money into Canada. And even though the US dollar has been strong, the Canadian dollar has outpaced the US dollar over the last month. Thank you, because I had a big long position on the Canadian against the US, and it just wasn't working for the longest time. And I put a video out saying, what's going on? Maybe it found its way around, and people thought, yeah, what is going on? Some big trading desks saying, hey, let's listen to this guy. But, when I think about, okay, let's say that I'm afraid of the U.S. and I got to get out of the U.S. Where am I going to go? Right. I mean, where am I going to go? I have a size that has to go somewhere. It can't just sit in the bank account. It's too big to sit in the bank account. And with inflation, you lose too much in purchasing power with inflation. I've got to do something. I got to be somewhere. And even though the U.S. has some volatility issues going forward for the next 3 or 4 months, I can't figure out where else I want to be. I don't want to be in Germany. What if Russia does shut down natural gas supplies? That'll send the German economy into a recession very quickly. I don't want to be in Europe. I don't want to be in Japan. I don't want to be in I look around and think, where would I go? Now, money has to perform. And, you know, for investors, we can take our money out and say, it doesn't have to perform. You know, I can sit on it for a while. It doesn't have to perform. That's not true for funds and institutional money. That money has to go to work, and it's a matter of relative asset pricing at this point as opposed to absolute asset pricing. So even though you don't like a particular market and you don't like the conditions, it's the least worst conditions you're going to find. Right? I mean, that's sort of where I am right now, thinking that, you know, I think we have volatility. I think we're range bound. I think we're up. I think we're down. I don't see new 52-week highs anytime soon, but I also don't see new 52-week lows anytime soon. I think the damage, where the damage needs to be done, the damage has been done. You know, when you have companies that are trading below book value, I think the damage has been done. You know, and we sort of have to think with the biggest risk factor right now is a policy mistake, is thinking that rising interest rates are going to solve this problem when it is predominantly a supply problem. And rising interest rates aren't going to solve it, which means it calls for higher rates, which will then call for higher rates, and you won't fix it until you truly break demand down significantly and do what Paul Volcker did, is just throw the economy in a recession to break inflation. But you could do that in 1980, because in 1980, you could conceive of the U.S. as an island. Not anymore. This is global inflation. It's not U.S. inflation. It's going to require a global solution. One country raising rates isn't going to fix inflation when the basis of all inflation, commodity prices, are globally priced. Right? And I mean, that is the beginning of everything that you need all of that to build things. And food too. Food is globally priced. Why should I sell in the domestic market? Why should I sell my wheat in a domestic market just because you raised rates? I will send it to the world market, and there'll just be a shortage, a domestic shortage here, which will push the price back up, and then I'll sell. Unless you have price controls in one country, you're not going to get away with it. So it is a different world we live in. This is one which does require, I think, a heavier focus on supply side and not demand side. Where's Reagan when we need him, right?
Excellent. Oh, excellent. No, I can't wait to hear the market update.
Well, there we go. I think we've covered a lot. I think there's a lot of interesting stuff in here to use. I'll chop up some parts that I think that we don't need, but we're done.